Hey everyone, Marcus here. Welcome back to the one-time close construction loan channel where we break down construction financing in plain English, not banker speak. Today, I'm thrilled to have Jordan with us. Jordan, thanks for being here.
Marcus, hey, absolutely. I'm pumped to be here, man. This has been such a crazy journey for me and my partner, and honestly, I wish I'd understood all this stuff before we started.
That's exactly why we're doing this today. Jordan and I are going to walk through FHA one-time close co-borrower construction loans. If you're thinking about building a custom home with someone, your spouse, your partner, a family member, this is the conversation you need to hear. Jordan's going to share real experiences, I'm going to answer real questions, and by the end of this video, you're going to know exactly whether this is right for you.
And Marcus, real talk, I was terrified of the whole co-borrower thing. Like, how does that even work? I had so many questions.
That's normal. Most people do. And that's what we're solving today. Stick around. By the end of this, you'll understand co-borrower qualification, liability, what happens if things change, and most importantly, how to actually pull this off without financial chaos. Alright, let's start with the basics. Jordan, when you and your partner decided to build together, what was your biggest concern?
Oh man, Marcus, honestly, I worried that having two people on the loan would complicate everything. Like, would we get denied because of something on one person's credit? Would we pay double fees? Would the process take forever? I was stressed before we even called a lender.
Yeah, that's incredibly common. Let me clear something up right away. FHA one-time close construction loans actually reward co-borrowers instead of penalizing them. When you have two qualified borrowers, you're combining financial strength. That's powerful stuff.
Oh, interesting. So it's not like we're two separate applications?
Exactly. It's one application, one approval, one closing. You're co-signing one loan together. FHA evaluates you as a financial team, not as individuals competing against each other.
That actually sounds way less stressful than what I imagined.
It is. Here's how it works. FHA combines your gross monthly income, both of you qualify together. Your approval is set from day one, no surprises, no re-underwriting, no, hey, sorry, we need to re-evaluate this 3 months into construction.
Okay, so how much money did we have to put down? Because that was a huge question for us, like our down payment, what was it?
Tell me about your build total, ballpark.
We were building around $425,000.
Okay, nice. So with FHA one-time close, you could have done 3.5% down. That's roughly $14,875 from your pocket. Did you guys do that, or did you bring more?
We actually had some family help. My parents gifted us $10,000 and my partner's sister gifted another $5,000. So we only brought like $3,000 ourselves.
Right there. That's the co-borrower advantage. Family members can gift to both of you separately. Each gift gets documented with a proper gift letter. FHA requires that. And boom, that money counts directly toward your down payment. No repayment obligations. No impact on your debt-to-income ratio.
Wait, it doesn't count against our debt to income?
Nope. Gift funds are pure down payment help. They don't get counted as income or debt. Your debt-to-income ratio is calculated purely on your earned income versus your loan obligations. That's huge for co-borrowers because it means more flexibility. Now, here's something most lenders won't tell you. And honestly, this is where you see the difference between real partners and lenders just trying to extract fees. We don't charge lender fees at closing, and neither should any legitimate FHA OTC lender. You're not writing separate checks for appraisal fees, inspection fees, processing charges, document prep, none of it. Those all roll into your loan. You walk into closing, you sign once, you're done.
So when we closed, there were no surprise fees because that's what I was most worried about.
Zero surprises. Your closing statement was clean. One number. That's it. Many lenders operate differently. They hide behind confusing fee schedules. Then boom, closing day arrives, and there are charges nobody mentioned. That's where co-borrower relationships fracture. One partner feels blindsided, but that shouldn't happen with a real one-time close lender.
Marcus, that's awesome. Because honestly, when we were shopping around, some lenders had all these weird fees, and we couldn't figure out what we'd actually pay until we called your team. It was simple and straightforward, unlike those other lenders.
I'm glad you did. Let's talk about what happened during your construction phase because that's where the real advantage of FHA OTC co-borrower loans shows up.
Okay, so construction starts. The builder breaks ground. Now what? Are we making payments during construction?
Great question. Traditionally, during construction, yes, you'd be making monthly payments. Your builder draws funds, interest accrues. You're writing checks while your house is still framing.
That sounds stressful.
It is stressful, but here's where FHA OTC construction loans are different, especially for co-borrowers managing shared finances. You have the option to establish an interest reserve within your loan.
An interest reserve? Explain that to me.
Sure. Rather than making monthly interest payments during construction, those interest costs get escrowed directly into your loan balance. Translation? Your money stays in your pocket while your home gets built. You're not writing checks. The interest is just sitting in your loan, waiting for conversion.
Oh wow, so when does that get paid?
Once construction completes and your loan converts to your permanent mortgage, you start regular principal and interest payments. That's when the interest reserve that accrued during construction gets folded into your mortgage payment calculation. But here's the thing. You didn't have to worry about cash flow during construction. That's powerful for co-borrowers managing shared finances.
That's actually brilliant. Because during construction we had other expenses. The site prep, landscaping decisions, finishes. It was a lot. So not having to scrape together monthly construction interest payments made a huge difference.
That breathing room is exactly the point. Construction financing shouldn't create cash flow crisis. It should give you space to build without financial panic.
So what about surprises? Like what if during construction something comes up that costs more money? Were we gonna get screwed?
This is where I want to highlight something that separates real lenders from the others. We build a contingency reserve directly into your loan, typically 5 to 10% of your total construction budget.
So the contingency is in the loan? It's not something we had to bring as extra cash?
Correct, it's built into the loan. And here's the critical part. If you don't use the full contingency, principal reduction applies. Unused contingency funds reduce your final loan balance. You end up with a smaller mortgage and lower monthly payments for the next 30 years.
Wait, so if we don't use it, we actually benefit?
Yes, completely. Now compare that to what most other lenders do. They demand a 10% contingency fee up front, cash you bring to closing regardless of whether you use it. That's a complete bait and switch on any low down payment promise.
Wow, okay, so during our construction, what if something came up?
Let's say it did. Tell folks what happened.
Actually, we discovered some unexpected grading issues once we broke ground. Nothing catastrophic, but it required more work than budgeted. The builder submitted a change order for like $8,000.
And what happened?
We didn't have to panic. The contingency reserve covered it. We just authorized it, the lender approved the change order, and boom, the builder got paid from the contingency. No emergency fund needed, no stress.
That's exactly how it should work. For co-borrowers who are sharing financial responsibility, knowing that surprises are already accounted for eliminates massive stress. You're not fighting about whether you can afford the unexpected cost. It's already in the loan. Let's talk about something that really matters for co-borrowers, the approval process itself. How did your approval work? Did you both have to speak with the lender?
Yeah, we both spoke with the loan officer. That was actually really helpful because I had a ton of questions, and my partner had different questions. Getting to ask them both at once made the whole thing clear.
That's ideal. Here's what the approval process looks like for FHA OTC co-borrowers. First, both borrowers speak with a loan officer on our team. You discuss your project, your finances, your timeline. Both of you provide documentation, tax returns, pay stubs, bank statements, employment verification. Both borrowers' credit gets pulled. Both middle credit scores get evaluated.
My middle credit score was around 720. My partner's was like 745. Were we good?
Absolutely. FHA minimum for one-time close co-borrower construction loans is more forgiving than conventional loans. You both exceeded that comfortably.
Cool. So what about the builder? Did that take long?
Good question. Builder approval typically takes 5 business days. Your builder submits licensing, insurance verification, and references. We make sure they're reputable, properly licensed, and capable of completing your project. Then the fun part, underwriting.
How long was underwriting for us?
Underwriting typically runs 3 days for FHA OTC loans. You had a pretty clean file, so you closed in 32 days.
And during all that time, we weren't re-qualified? Like, nobody called us saying, oh, we need to dig deeper?
Nope. That's the beauty of one-time close. Your approval is solid from the start. Unless something dramatically changes, like one co-borrower loses their job or takes on major new debt before starting construction, you're not re-underwritten. Your approval holds. Let's talk about something that matters to co-borrowers specifically, the interest rates and rate protection. Jordan, when you were building, did interest rates change?
Yeah, they went down a little bit, maybe 0.5% if that.
So, here's what happened for you. Instead of locking your permanent mortgage rate months before construction completed, which other lenders force, your rate floated with the market. You didn't lock until days before you moved in.
So we got that rate drop automatically?
Exactly. If rates had gone up instead, we'd have protected you with our rate cap guarantee. You get market advantage if rates fall. You're protected if rates rise. That's genuine financial security for co-borrowers.
That's awesome. So we basically benefited from rates dropping, but weren't exposed if they went up?
Precisely. Now imagine the opposite approach some lenders use. They lock you in a rate 8 months before construction completes and charge you thousands of dollars in non-refundable advanced lock fees. Rates drop 50 basis points. You're stuck at the higher rate for 30 years. As co-borrowers managing shared finances, you're both watching money slip away needlessly. Our approach eliminates that problem.
I didn't even realize that was happening. I just thought that was how it worked.
That's exactly what most lenders count on. Confusion. They lock early, charge extended lock fees if rates drop, and borrowers don't even realize they've been trapped. We believe differently. Your rate is your rate. It floats until completion. You capture the market's best available rate at that moment. Now let's talk about something that matters for any co-borrower arrangement. What happens if things change? Jordan, during your build, did anything change with either borrower's situation?
Actually, my partner got a new job about midway through construction. Different company, better title, different income. Was that a problem?
Great question. And here's the real answer. No, it wasn't. You know why? Because FHA one-time close loans don't require requalification mid-construction. Your approval was set from day one. Mid-construction employment changes don't trigger re-underwriting.
So it literally didn't matter?
That's correct.
That's incredible. Because honestly, I was worried that might derail everything.
Most co-borrowers worry about that. It shouldn't. That's why FHA one-time close is so powerful for co-borrowers. Your approval is locked, your timeline is locked, your costs are locked, life happens during construction, but your financing doesn't get destabilized by normal stuff. Let's talk about liability because this is something co-borrowers absolutely need to understand. When both of you are on the loan, you're both 100% liable for the debt. If one co-borrower can't pay, the lender pursues the other. That's how it works.
So if something happened to me, my partner would be responsible for the whole loan?
Yes.
Oh, interesting. So the loan is in both names?
Yes.
Got it. That makes sense.
Here's a tough topic, but an important one. What if co-borrowers split up? I know that's not fun to think about, but it happens.
Oh man, I don't want to think about that, but yeah, what happens?
During construction, you're both still liable for the loan. During a divorce, the property becomes a marital asset subject to settlement. A court might award it to one co-borrower, require its sale, or split proceeds. The loan, both names stay on it unless refinancing removes one borrower.
So you'd basically have to refinance one person's name off?
Exactly. After construction completes, if circumstances change, the remaining borrower can refinance and remove the other from the loan. This requires the remaining borrower to qualify independently for the loan amount, but it's absolutely possible.
Okay, that makes sense. Fortunately, not something I'm dealing with. My partner and I are rock solid, but I get why people need to know that.
Exactly. It's not the fun topic, but it's important. Co-borrowers should go into this with eyes open. Let me ask you this, Jordan. If you had to tell someone considering an FHA OTC co-borrower construction loan whether to do it, what would you say?
Honestly, do it. Especially if you're with someone you trust completely. Because here's the thing, building a home is stressful. Having financing you can actually understand with no hidden fees, no surprise requalification, and a lender who actually partners with you instead of extracting fees. That removes so much stress from the process.
That's powerful feedback. What would you do differently if you could do it again?
Honestly, I'd start the conversation with you guys earlier. Like, before we even had a builder selected. We figured out a lot of stuff on the fly that we could have understood up front. But your team was patient, explained everything, and we got to the finish line without chaos.
That's the right approach. Getting clear on financing before builder selection makes everything flow smoother. You know your budget, you know your monthly payments, you know what's realistic, then builder selection becomes much easier. Alright folks, here's what we've covered today. First, FHA OTC co-borrower construction loans combine your financial strength. You qualify together, you close together, you build together. That's powerful. Second, your down payment can be minimal, 3.5%, potentially lower with gifts. Family members can gift separately. You control the total down payment between you. Third, no lender fees at closing. Everything rolls into the loan. Your closing is clean and transparent. Fourth, interest reserves mean no monthly payments during construction if you choose that option. Your money stays available for other needs. Fifth, contingency reserves handle surprises. Unused contingency reduces your final loan balance through principal reduction. You actually benefit from prudent planning. Sixth, your rate floats to market rates at completion. You capture favorable drops. You're protected against increases. That's genuine rate security. Seventh, your approval is set from day one. No re-qualification mid-construction unless something catastrophic changes. That's stability. Eighth, you both share liability for the loan, but you control how you take title separately. Work with an attorney on that. Ninth, if circumstances change, employment, divorce, whatever, you have options. Refinancing can remove co-borrowers. Title arrangements provide flexibility. 10th, this is real. This works. Co-borrowers successfully build homes together every single day, using FHA OTC construction financing.
Marcus, what if someone's watching this and they think, yeah, this sounds great, but I'm worried about something specific?
Pick up the phone. Seriously, call us at 888-857-8041. We'll talk through your specific situation, your credit, your income, your project, your co-borrower arrangement. We'll answer every question. We'll clarify every detail. No pressure, just genuine consultation.
Yeah, call them. I'm so glad we did because this whole experience has been way smoother than we imagined. The other lenders we called were a nightmare.
That's what partnership looks like. Okay folks, before we wrap, I want to be really direct about something. If you're shopping around for an FHA construction loan and another lender is pressuring you into a two-time close, telling you FHA construction loans don't exist as one-time close, charging hidden fees, or complicating what should be simple, walk away. There are lenders who profit from confusion. They charge contingency fees up front. They lock rates early and charge thousands for extended lock fees. They require re-underwriting mid-construction. They extract every fee possible. We don't operate that way. We believe FHA OTC co-borrower construction financing should be straightforward, transparent, and partner-focused. So if you're ready to build your dream home with a co-borrower, call us at 888-857-8041 today. Let's have a real conversation about your situation. For more helpful videos on how we can help you achieve your dream home, make sure to like, share, and subscribe. Also put your questions below in the comment section. Don't forget to call us at 888-857-8041.
Yeah, seriously, call them. This has been awesome. Thanks for having me, Marcus.
Thank you, Jordan. Appreciate the real talk. Folks, we'll see you next video.